Hi, this is Mike Coppell, and we're here today to talk about passive activities. All right, let's start. There's my picture. There's my contact information, my direct line to Gray, my cell phone number, and my email address, and you can use any of those in order to contact me. I want to start with a little screen that I've been putting in all of my presentations that basically says, don't let the tax tail wag the economic dog, which means that we have to remember that while this is a tax presentation and I'm basically a tax person, what we have to understand is you shouldn't be making transactions and moves just for tax purposes. They should make business sense, and we have to make sure that things do make sense from a business sense, not just for tax purposes. So why is it so important that we're putting on this presentation and we're talking about the difference between active and passive at this time? What you have to understand is that PPACA, or is commonly called Obamacare, basically started off and basically now says that people that are in a pass-through entity, in an S-corp, in a partnership, in an LLC tax as a partnership, that are passive could be subject to additional taxes at a rate of 3.8% if they exceed a certain threshold. So the first thing we have to remember is that we're talking about net investment income. And what the law now says is that if you are a passive investor, and we're going to talk about the different definition of active passive in a couple of minutes, if you are a passive investor and you have high income, and high income in this case is defined as adjusted gross income, the number on the bottom of page 1 of your tax return, if that is in excess of $200,000 if you're single, $250,000 for married filing joint, if that is the case, you're going to have to pay an additional 3.8% on that high income. And basically, let's take an example. Let's suppose that you have total investment income, which includes, we'll talk about in a minute, interest, dividends, most capital gains, and so on. If you have that, and if that is the case, you're going to have to pay, if you have $270,000 of AGI and you have $10,000 of that, you're going to have to pay it on the $10,000. If you have $270,000 of AGI and you have $30,000 of net investment income, you only have to pay the amount in excess, or the $20,000. So the 3.8% is basically taxed on interest, dividends, rents, royalties, and annuities, capital gains except for the sale of property held for trade investment that is not passive. And this is the key here. The word is passive. So this is why we're so concerned about the term active-passive, because if you are passive in this transaction, then you're going to wind up having to pay tax on it. So let's talk about an S-corp. In an S-corporation, basically the person that takes wages, those wages are not going to be subject to the 3.8%. However, if you are passive, the income you receive on the K-1 is going to be subject to the 3.8% tax. The same thing is true in partnerships, where if you are passive, you wind up having to pay the 3.8% tax. A couple of things I want to make sure people understand about partnerships. First is that spouses are treated the same. So if one spouse is active, the other spouse is treated as active by definition, and we've seen a lot of cases in the last few years where that's been done incorrectly on tax returns. The second thing is that I want to make sure people understand about the importance of the classification on a partnership tax return. On page 5 of the partnership tax return, it was page 5 last year at least, there's a little chart, and that little chart says what entities, individuals, corporations, trusts, blah, 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 are active and what are passive. And what the IRS has indicated is that they consider that to be a good starting point. And if they're going to go in and they're going to look at people and say, okay, Mr. Partner, Mr. and Mrs. Partnership, who is treated as what, and then they're going to look at those partners and make sure they're treated the same when they do their tax return, on the assumption that the partnership entity actually knows who is doing what amount of work in the partnership. And we'll talk about that in a couple of minutes. I don't want to spend a lot of time on bifurcation. Bifurcation is a tool that we and many other high-quality accounting firms and tax advisors have been using for about 12 or 13 years in order to minimize self-employment tax. If people haven't been talking to you about bifurcation, please give us a call and we'll talk about how we can sit there and make sure we minimize your self-employment tax and minimize the new 0.9% tax on self-employment income. I want to talk about guaranteed payments. Guaranteed payments are important because the guaranteed payments are going to be considered for the 0.9% self-employment tax, and we have formulas that we use to make sure that the guaranteed payments that are made to LLC managing members are indeed reasonable. I want to talk very quickly and about real estate professionals. Real estate professionals are a very, very important concept because basically rental income is considered to be passive by definition. The one exception to that is if somebody is considered a real estate professional. And real estate professional is a broad definition and takes in all kinds of activities in the real estate area, be it real estate management, ownership, and so on. It is something that will avoid the passive income definition for rental real estate, but it also has other consequences. And that if you want to talk about real estate professional, it's something you should give our office a call and we'll talk about it with you at length. So let's talk about active passive. All right. The Internal Revenue Code defines an active person as someone that works on a regular, continuous, and substantial basis in the operations of an activity. There are 7 definitions for being active. The one that is used 99% of the time is number 1, and that is the taxpayer works 500 hours or more during the year in an activity. If that is true, other than rental real estate, and unless you're a real estate professional, you are considered to be an active participant in that activity, and the 3.8% by definition will not apply. The second definition, which we see not very often, but probably second to the first, is the taxpayer does substantially all the work in the activity. And, that's something that we do see periodically, but as I said, the one we see most often is the first. The third definition is the taxpayer works more than 100 hours in the activity during the year, and no one works more than that. No one works more than that. So basically what this is simply saying is if you work 100 hours in an activity and there is no one else involved, and that no one else involved includes other members, people that you hire, and so on, that would mean you're not active. I don't think I've seen this in the time since passive activities have come in 1986. I don't think I've seen this more than a handful of times. The activity is a significant participation activity, and the sum of the significant participation activities in which the taxpayer works is between 100 and 500 hours, and they exceed 500 hours in aggregate for the year. I've never seen this used. It is something you can do, but I've never seen it. A significant participation activity is a trade or business activity in which you participate more than 100 hours during the year, but did not participate. And so basically what you're going to have to do is you're going to have to aggregate all of these significant participation activities. I've never seen this happen. It does exist. It is something that if you want to talk about it in more length, give me a call and we can do that. Number 5, the taxpayer materially participated in the activity in any 5 of the last 10 years. This is obviously a backward-looking definition. It is one that you can talk about. It is one that works. I've seen it a few times, but it is unusual for somebody to go from being actively participating to non-actively participating. That's pretty unusual. It could work in a situation where you have somebody that has worked in an activity for a while and then retires. That could be effective for them. But other than that, this is really not something that we get involved with. Number 6, the activity is a personal service activity, all right, such as any of the professions, accounting, lawyer, architect, and the taxpayer materially participated in the activity in any 3 prior years. Once again, this would be something that is effective for someone that's going to be retiring or so on. Number 7 is based on all the facts and circumstances. The taxpayer participates in the activity on a regular, continuous basis during such year. However, this test only applies if the taxpayer works at least 100 hours in the activity and no one else works more than the taxpayer in the activity, and no one else receives compensation for managing the activity. I have never seen this in the 25, 28 years that this has been, that we've seen passive activities. It does exist, and I suppose that you could do it. I don't know how you're going to prove this, but it does exist. What is really important here is people have to understand that the IRS is sitting there, and they are actually, especially with real estate professionals, but also they're going to start doing it more and more and more with all activities, is how does a taxpayer prove the number of hours? And remember that basically the vast majority of all of the definitions we talked about previously for active all come down to measuring hours. And basically what the rules say is a taxpayer may prove their hours of participation by any reasonable means, including but not limited to appointment books, calendars, and narrative summaries. Well, that's what the rules say. However, what we're finding is that the IRS is looking almost exclusively for you to demonstrate through appointment books, calendars, and other hard documentation, travel logs, airline tickets, and so on, that you actually did it. Narrative summaries they don't really like, because basically all you're doing is writing things down, and a lot of that is done after the fact. They want to see some really hard evidence in this case. We are strongly recommending that people keep track of all of their hours on their calendars. You know, you can use your Outlook calendar, you can use a date book, you can do whatever, and that you keep all of your activities in one place where it is easy to figure out and keep going. I want to talk about real estate professional just briefly. A real estate professional, number 1, owns at least one interest in rental real estate. More than 1/2 of the personal service of the taxpayer performs in the trade or business of real estate during the year are performed in real property trades or businesses in which the taxpayer materially participates. Understand what they're saying here. What they're saying is that more than 1/2 of your time has to be done in trades or business, and you have to materially participate in those activities. You know, this is really hard to prove. It is really important that you keep track of everything in date books and other things. Number 3, the taxpayer performs more than 750 hours of service during the tax year in the real property trades or business in which the taxpayer materially participates. Once again, all comes down to hours, 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 and documentation. If you are a real estate professional, if you are involved in the real estate business and you have rental income and you want to be treated as active, this can be a very, very powerful tool. But you really have to call somebody that understands this. Give a call in our office, and we'll be happy to walk you through it. Why are we talking about this now? We're talking about this now because if you want to be treated as being active in a trade or business in 2013, you have to start making your plans now. The PPACA Obamacare tax increase to 3.8% starts in 2013, so that if you want to be active and avoid that definition, you should start keeping track now. Also, the other thing that we have to talk about is that under normal circumstances, once you group activities, once you take different things that you do and you group them for tax purposes, you're not allowed to change that grouping. However, what the law says is that in 2013 and 2013 only, you can make a one-time change to the grouping of your activities. This is something you should be talking about with your tax professional right now as you're doing 2012 year end, so that you're actually planning what you're going to be doing with regard to active, passive, and regrouping of activities. And starting for 2013 going forward, you should be looking at that now, along with what you're doing for hours, and figure everything out in order to minimize the effect of the net investment income 3.8% tax. What is interesting here is limited partners only can use items 1, 5, and 6. As I talked about, number 1 is the most common thing, which is your number of hours that you're using. It's kind of unusual to have a limited partner also as being active. However, that is now allowed, but it has to really be number 1, which is the 750-hour test, or that your spouse is active, as we talked about previously. One thing that people often misconstrue is material participation versus self-employment tax. These are two entirely different Internal Revenue Code sections in two entirely different areas of the code, and really, surprisingly enough, have nothing to do with one another. So that you can have material participation, the active-passive determination, and your self-employment tax determination, and they really don't have to have anything to do with one another. And that's one of the bases that we talked about previously. We talked about bifurcation. That is one of the ways that we take advantage of bifurcation in order to minimize self-employment tax. And I just want to make sure that people understand that whether you have self-employment tax and whether you're going to wind up having to pay the 3.8% net investment income because you're passive actually don't have anything to do with one another. I want to mention the repair regs very quickly. The repair regs have been extended or delayed so that they don't take effect until 2014, which is good news. In some situations, especially if you're in a real estate environment and you had major improvements to your real estate, such as replacing a roof or replacing all the windows, for example, if that's the situation, you may want to talk about early adoption of some of the repair regs. This is a very, very complicated area. It is something that if that's the situation, give me a call, give our tax department a call, and we can talk about whether or not that makes sense for you. Once again, here's all of my contact information. If you have any questions, please feel free to contact me. 3.8% is a huge amount of money, huge tax that is sitting over some people's heads. Once again, it is definitely going to affect a lot of people. If you have any questions regarding the net investment income tax, if you have questions about the earned income tax, new earned income tax, or any of the other new taxes, please feel free to give me a call or give somebody in our office a call, and we'll be happy to help you. Thank you very much.